With me is Brian Sozzi of Wall Street Strategies. The luxury names had an ugly week on the tape. Why do you think investor sentiment has shifted in these names?
It shifted very quickly, and I think what we've seen is a more cautiousness on how the domestic consumer will spend for the holiday season. You have to split the domestic consumer up into two ways when you're talking about the high end. You have the super high end. I think the market was looking for big things from the holiday season. Maybe you see a little pullback with everything that's going on in the markets, and you also have the aspirational consumer. Aspirational consumer is the one that from 2006 to 2008 traded up to the likes of Tiffany & Coach. And the thinking was that, maybe possibly they would come out and buy a little bit more for this holiday season. But ultimately this week, all about China.
What about China? It hurt every industry across the board. What's going on there?
China, last week, it wasn't even the news. This week, apparently, now we're looking for a hard landing. What you're seeing from China is concerns over their interest rate tightening cycle campaign that's been going for a while. And that is starting to show up in the economic numbers. Most recently, the manufacturing data that they have. But importantly, when China, and you pair it up with retail, China has been the third stool in the leg of the investment thesis. Every U.S. retailer is looking to China. They're investing so many of their assets, so much of their capital into China because that's where the growth market is. First, it started in the Tier 1 cities. Now it's spreading like a weed to Tier 2 and Tier 3.
I saw today in Real Money that you said the key decision for picking out names is how it looks for a buy or a sell on the charts. Talk to us a little bit about that, and what is your favorite name going into a tough group?
Well, the key thing with retail is Benjamin Graham disciples just don't even apply for this job on Wall Street if you want to be in the equity research department. It's not happening for you. You have to make quick buy and sell decisions based on chart patterns. If I look at Tiffany & Coach, chart pattern tells me the stocks are falling below their 200-day moving average, and I still think there's downside there. You don't necessarily want to go in until that selling ultimately subsides. You want to have a quick trigger, get in and out, and we can't necessarily have a look to the holiday season at this point. I think sentiment is muted, and we don't know how the season will pan out. But if you want to get cute, I think you're looking for stories outside of the holiday season. One name would be Herman Miller. They sell ergonomic office furniture. Okay,
so Tiffany, Coach, what's your favorite name? If you had gun to head, what are you looking at?
Gun to head, I would still go with Tiffany's at this point once that selling subsides. Maybe around 55, 56 would kind of intrigue me about Tiffany. Maybe I'd take a nibble there. One, because I think they have a great pricing power across the board, not only in the US, but also internationally. And if you drill down to how they're exposed in Europe, in the EU area, they don't have that much exposure to some of the debt-ridden problem areas.